Has Pick n Pay got a new lease on life? Investment managers like SIM Unconstrained Capital Partners have recently been adding the share to their portfolios. Rico Frederick is back with us to discuss the investment case offered by one of South Africa's largest retailers. So is that the reality, Rico? You adding Pick n Pay to your portfolio because of this change in management? Is it about backing the new players?
We have been invested previously in Pick n Pay. So for us, this is the first time since the financial crisis that we've in fact added Pick n Pay to the portfolio. And yes, I think part of it certainly has to do with a change in management. We've always recognized that Pick n Pay has a very strong position in the food retail market in South Africa, but we're concerned around the speed at which the management team was responding to the not insignificant challenges that the company was facing. We have also a big investment in Tesco, so we understand the experience and the solution-solving abilities that Richard Brasher brings to Pick n Pay. And the problems that he has to deal with, in our opinion, are not necessarily new problems. They're problems that Tesco has had to deal with in the past before. So from that point of view, we are a lot more encouraged at the potential speed at which a lot of these challenges will be addressed going forward.
Rico, we wanted to get into that a little bit and just outline, you identified some of the problems that the Pick n Pay had suffered from, including lost market share, transition to a centralized distribution model, and the introduction of the Smart Shopper reward system. So do you have a fairly good grip, or do you need a fairly good grip on what Pick n Pay need to do now specifically to get back their mojo?
Look, I think the bottom line is they need to grow their revenue, which ultimately means for them gaining back their lost market share. And when you start to unpack this and you start to understand the different facets in terms of what are required to get the customer back into the store, it's quite complex. It's not as simple as fixing distribution or as simple as addressing the high cost associated with the Smart Shopper card. It's actually about creating enough of an incentive for those shoppers that have now gone elsewhere to come back to the Pick n Pay store. So it's about a fresh look in the store, it's about the merchandising, it's about the pricing, it's about ensuring that the product is on the shelf so that the customer is not disappointed and doesn't go somewhere else. And a lot of these other factors that we talk to all need to fall into place to make Pick n Pay again a more attractive destination relative to where some of the competitors have got to over the last decade.
Rico, there is the additional problem that we could see the South African consumer as a whole coming under pressure, further pressure, once we see interest rates starting to tick up, which is inevitable at some stage. That's another environment that Pick n Pay is going to have to contend with the general retail grouping, which could see a re-rating of retailers downwards as a group. Would that make sense?
We absolutely concur with that. There's no doubt that we're going through, and will continue for a while to go through, a fairly tougher period from a consumer trading point of view. One must bear in mind, I guess, that Pick n Pay has not really re-rated to the same extent as the other retailers have because of the problems that they've experienced over the last several years. And number one, and number two, I think when we invest in Pick n Pay, as we have recently started to, we also understand that it's going to take them several years to address the challenges and the problems that they're facing now. And by that time, the consumer environment will probably be very different to what we face today. So if we look at the relative opportunity set, looking at Pick n Pay versus a ShopRite or a Massmart, undoubtedly from a value point of view, we think that over the next 5 years, Pick n Pay will more than likely do substantially better in terms of the total returns it can generate for shareholders versus the very highly rated competitors at the moment.
Rico, you've also been, you also talk about in the newsletter, obviously, the incredible run that the industrials have and how you've been selling those down. But you also mentioned that you've been finding value in the banks, and ABSA is your preferred pick. Just take us through the thinking there between, I guess, the big four, and you also include Investec in your analysis as to why ABSA at the moment offers the best value.
I think, we acknowledge firstly that a weak rand generally is associated with a tougher period, not only for the retailers, but generally for credit and for demand for credit. And the banks obviously have come off quite substantially on the back of that too. Generally, it's this mispricing opportunity that has led us to particularly the banks and ABSA, which we think looks fairly attractively priced relative to the other banks. They've also not necessarily covered themselves an enormous amount of glory with respect to some of the challenges that they've been facing in their home loan book. But by the same token, though, they've also been quite conservative and not participated in this significant growth that we've seen in the unsecured lending space. So relative to all the other banks, we see fairly little downside risk given their conservative exposure to the growth in unsecured lending. Secondly, they're also sitting in a fairly good position in terms of excess capital. And once, as we've seen now, this Barclays Africa deal has been concluded, we think there's a very high probability of a special dividend coming back to shareholders. And maybe thirdly and lastly, they're sitting on fairly depressed return on equity. A big contributing factor to that low return on equity are the elevated level of bad debts. While a lot of the other banks' bad debt ratios came off after the financial crisis, that wasn't the case for ABSA. And we see a steady and slow but declining trend in those bad debts, resulting in increasing return on equities going forward. And on that basis, not only are you getting a good return out of dividends, but we think you're going to get a good return out of the growth in the net asset value, and possibly even a higher rating on that net asset value going forward. And that's with a fairly low degree of risk relative to a lot of other opportunities that we're seeing not only in the financial space, but definitely in the industrial sector as well.